Welcome to this breakout session. It's FET and FATCA, Foreign Account Transaction Compliance Act. That's the first test, to try and remember the acronyms. There's a lot of acronyms with FATCA, so forgive me if we go over them. I'm Stuart King, Managing Director of FR Global Advisors. It's a new business unit within FiscalReps. Our main remit is actually to bring the global platform to a lot of our captive.
Wrap up, if you don't mind.
You're gonna.
Running out of time.
Oh, this is the next one.
This is the next one.
Yeah.
Oh, sorry.
Okay.
You're very quick turning around the room. Sorry.
Bit of a Ryanair service here, I'm afraid. I think the others couldn't wait to get out. It's probably true. So FR Global Advisors, a newly formed business within the FiscalReps group. Our main remit is actually to provide management advisory services to the captive management industry, particularly leverage a lot of the expertise and processes and procedures of not only Mike's European business, but Asher Harris, US business. Asher was due to do this presentation. Asher is a New York lawyer, tax lawyer, and so he's very technically proficient, so forgive my in-depth technical knowledge, but I will run through the slides in the best I can, but any technical questions I'd be happy to take away or give you Asher's contact details. We did try a video conferencing and video clips and audio, and I was just to press a few buttons, but that didn't quite work out, so I'll do my best. The session is split into two parts, FET, which is more of a refresher because there's no real material legislative changes other than quite an interesting case that's going on at the present time within the courts, and the Foreign Account Tax Compliance Act, which wasn't particularly high, I must admit, as an advisor previously on my radar, because from a non-life insurance, particularly captive perspective, it just felt like it didn't apply because it was, life, annuities, okay, it doesn't really apply. But now there's been some more interesting developments, particularly from the sort of headwinds from the broken houses, particularly the US guys, that FATCA status and confirmation is becoming a little bit more important. In preparing for this, I found an IRS mission statement, which, again, I'm beginning to familiarize myself with more technical tax stuff, but I thought it was quite funny. Provide America's taxpayers top quality service by helping them understand and meet their tax responsibilities, and by applying the tax law with integrity and fairness to all. I haven't had too many run-ins in my career with the IRS, so I couldn't really comment, but I do know others that may find that quite interesting. Asher and his team do a pretty good job, I think, of decoding the language between corporates and the IRS, so they seem to be doing quite well. And as you can see, a real bold American symbol statement there, particularly the Department of Treasury. So moving then into the FET, as I say, there's been no real recent major change, but I've no doubt there's a lot of things going on in the background with historical questions, particularly around cascading taxes and tax treaties in place between the US and countries where premium is coming inwards and going outwards. So the slide will be kept very simple. It helps me. We'll touch upon the basics of FET, a bit around treaty exemptions and what they actually kind of mean, and some cascading excise tax, the revenue rulings and announcements, and a bit of recent audit activity and some of the inquiries that Asher and his team are seeing on their side on notifications from the IRS. I pass on some of those experiences. So I guess the basics of FET, it's an excise tax imposed on reinsurance and insurance premiums paid to non-US insurers for US risk. 4% applies for non-life insurance, and 1% on life and reinsurance. So treaty exemptions, the tax is waived if the insurer of the foreign country qualifies for treaty benefits, and an example would include a country like Ireland, where US risked premium tax doesn't apply. But it only applies if they are not reinsured to a non-qualifying reinsurer. What I mean by that is if you take the premium into a country like Ireland and then you transfer the reinsurance outwards, it's quite important where that reinsurance goes. The IRS does allow for a closing agreement with foreign insurance to confirm the treaty available, but it's not a requirement per se.
Does the IRS accept that it's not a requirement? Because my understanding is they're audit.
Yeah,
the procedures actually state that they require.
Yeah, for some brokers, yeah, it does apply for that way. In my view, and what I've seen, the closing agreements are becoming more popular, but up until now, they haven't been. So there are anti-reinsurance clauses within the treaties. If premiums are reinsured to a non-qualifying reinsurer, the initial transaction does not qualify for treaty protection, and I think that's where you end up in a sort of this doesn't make a whole lot of sense kind of territory, because if you imagine a transaction between a US client going to Ireland, going to Bermuda, you would think that at least at the first leg it should be exempt, but unfortunately it's not the way it is. And in the next slide I'll give you an example of actually the following slide, how that actually works. And the IRS's view is that any transaction related to US risk is subject to US FET, even if a previous leg was subject to tax. Although this was the IRS view for quite some time, it was amplified in some recent rulings in 2008, which kind of clarified that position of cascading tax. So there are a number of other examples within that particular ruling, but the one relevant to us was actually the cascading perspective. Some of the others probably closer to the market will maybe be familiar with the Validus reinsurance current challenges that are going through in the District of Columbia, actually. And I thought when I was reading it, the actual amount involved, I believe and I read, was $500,000. Not a great amount in the grand scheme of things, but that certainly buys you a lot of lawyer hours if you were to defend that. So I'd be quite interested to follow this now and the outcome of that, because I think it will have a lot of impact within our industry. You were likening it to things about betting on US sports, that whether you should pay tax if you're not in the US or not a US resident, because there's some view that a reinsurance contract is separate transaction to the original US risk. They've got points on both sides, so I'd be quite curious how that actually pans out. I think it will have big impacts within the industry, so hopefully it makes things easier for us. A quick example, some of you may be familiar with the basics, but I'll run through this. Company A purchases the insurance from an insurer X, located in Ireland, and is eligible for the FET exemption. But the insurer then reinsures to a reinsurer in Bermuda, which is a non-treaty country. The insurance subject to 4% because the reinsurance with a non-treaty country removes that. And the reinsurance is subject to 1%, so effectively a 5% charge. That doesn't seem very fair to me, but unfortunately that's the way, I guess, everything is kind of coded. In terms of recent activity, other than the Validus case, there's not really much happening, but Asher and his team are seeing a lot more assistance to clients where they've received information document requests. And having had a look at a few of them, to me, or the tip, if you like, is actually knowing where your policies are. Because a lot of these things aren't just 12 months ago, a lot of them are historic. And when they begin to list a lot of the information that you need, practically it can be very difficult to find that. And so I guess there's a bit of a tip that Ash has asked me to pass on, is to make sure the documentation is in place, which I'm sure it is the case. Notices of deficiency are where the IRS have sort of made their view on the world. And really, a lot of clients get into trouble when they don't respond to the basics or delay in responding. Often, maybe they don't have the right IRS desk officer. So it's sometimes important to speak the right language or to know the right individuals. I think, in a practical sense, what the information documents being requested are trying to substantiate the claim and the back end of the principles of the FET. So I'd be quite curious to follow this as things develop. I mean, as an audience, is FET high on your agendas, or just to give me a bit of a feel on insurers, brokers, clients, or captives? Has anybody had any challenges? Do we all agree with the cascading tax principles? A few smiles in there. Okay. So that brings me around to something I know a bit more about than FET. We can take a break and go if you like before I start. As I say, for me, it wasn't really high on my agenda. Not, as I say, non-life. It was just another compliance, another piece of paperwork. But as I've sort of gone through it, reading a lot of documentation, which sometimes confuses you more than anything. But I found the IRS website itself and the updates they give is very good, very clear. FATCA isn't, from an internal process perspective, isn't supposed to be a new process. It should actually be part of continuing anti-money laundering, know your clients, the general governance that we've all been fortunate to be applied to us. The presentation is intended to provide you with a brief overview, its relevance to the industry, the insurance industry, some key points to put FATCA into perspective. I don't know, maybe you have the same as me. I seem to read a bit more in the press every day about new IGAs, intergovernmental signing up Bermuda, Cayman, Isle of Man, and what they actually mean. In summary, the presentation will follow the following areas. Overview, key dates, the various entities that you may hear knocking around the sort of conversations and press. More to explain to you some of the financial acronyms. Withholdable payments, key areas that may interest you directly. And finally, some compliance considerations. So, as an overview, and I think the very first bullets is always worth to keep going back to if you ever get lost in trying to determine what FATCA actually means to you as an organisation, because we sometimes lose sight of the actual principle of what it's trying to achieve. And what it's trying to do is prevent US taxpayers who hold financial assets in non-US financial institutions from avoiding their tax obligations. I'd say there are a lot of private individuals in the US a little bit worried at the moment if they open up a bank account in Liechtenstein or one of those countries. But I think that's what they're trying to do. They're trying to capture more tax. And I think, unfortunately, like anything, we as an industry get tagged into that in some shape or form. FATCA became law in March 2010. The regulations issued in January 2013. There was a slight delay from the original timelines of about 6 months, which gives people a lot more time to prepare. But from July the 1st onwards, there will be the requirement to withhold 30% if you can't demonstrate your FATCA status. And if you can't, that can be probably quite a big headache for some firms. The number of abbreviations that are used is quite difficult to remember, so that's the kind of first challenge. But once you've identified what type of entity you are, the rest is relatively formulaic. with the process. I saw commentary that it takes about 8 hours to fill out the actual form and get the documents together, but as an organisation, to try and understand where your legal entities are at, where your clients are at, trying to put that into a new process into your compliance teams is an evident challenge. If you are deemed to be in scope for FATCA and you are what they call a foreign financial institution, an FFI, you have to apply for a Global Intermediary Identification Number, a GIN number is what you may have heard with the IRS. It's a bit like a bank account number that has your own referenced entity and identification numbers. So you may have heard about sort of intergovernmental agreements, and sort of trying to put it simply, there are two. There's Model 1 and Model 2. Model 1 would include countries like Germany, France, Ireland, the UK, and Model 2, Japan and Switzerland. Now, the main difference between them is, for example, in Model 1, particularly in Ireland, if you have a fund industry and you've got a lot of underlying clients, it would be impossible to identify everybody, particularly in the securitization market. It's very challenging. So the IRS have relied upon the local authorities' processes and procedures of regulating you as an entity, and then they report to the IRS in a batch amount. Whereas Model 2 countries like Switzerland can often have conflicts between local law and national law. And so a lot of those guys may not want to give up all of their information to one central repository, and they'd like to actually respond back to the IRS directly. So the Model 2 makes that possible for them. A US withholding agent is another key influencer within the environment, and really one where a lot of the important accountability sits, and that's where I think you get a lot of providers now perhaps confused on the FATCA status. So there's some clients that they take a broad brush approach, and I can kind of understand that, but I don't perhaps agree with that. For insurance companies who are not sort of investment linked, are not likely to be burdened, but nonetheless have to go through the process. And what they're trying to capture is products which, particularly life, where they've got more investment attributes to them. And that can be quite difficult to identify, particularly as bank and insurance can often be a grey crossover line. So some key dates for you. We're fortunate enough for a 6-month delay, so that means we now all have to rush and get everything done. But I think people would be wise to review their internal processes and procedures now. From July the 1st, withholding tax will apply. But the IRS website for application of your identification number isn't live until the 1st of January, so you can't actually be formally given your number yet. If you put all your information in by April the 25th, you'll be on the first list, which will be published on around the 1st of June. And that list is a sort of a reference point for a lot of providers, that if you're on the list, that's your confirmation of FATCA status. If you're not, then you have to provide them with supplementary evidence, documents and the likes. Again, from the 1st of July, the withholding tax will occur. And in the coming slides, I'll explain the various entities, withholdable payments, and the impact, as I see it, to the insurance industry. So the key influencer, US withholding agent, is a person that controls or receipt, custody over disposal or payment of withholdable payments, generally a non-individual. And I think that's a lot of brokers, insurers, fund managers who are managing sort of clients' money. There are certain exempt entities. They include government agencies and non-profit guys. FFIs, foreign financial institutions, that's the list of all of them. From an insurance perspective, we're only really concerned with a specified insurance company, but just to give you some perspective, a depository institution is a bank, custodial, a mutual fund, investment entities, hedge funds, and a holding company, sort of any of the above, if you like. From an insurer, again, it impacts a lot on the sort of annuity type products, cash value products, life stuff. Another sort of, they call it non-foreign financial entity, and they have three classifications: acceptive, active, and passive. The first two primarily are vehicles that corporates use for the likes of patents, royalties, and those type of things, but who have bona fide businesses which are used in a bona fide way, and they're likely to be sort of corporate PLCs. So they're not really in scope with the IRS, not too worried about that. But the passive is one where you'd be required to provide, if you had a lot of joint ventures or a lot of organizations with many shareholders, you'd have to identify those US individuals. So a quick caption on withholdable payments. They really have to be sort of fixed, determinable, annual, and periodic. And as you can even see there from a non-life perspective, many of them don't actually apply. But when you start beginning to peel back actually the different players within the environment, the insured, the broker, and the insurer, you then get an appreciation of where it may actually apply. For the insured, I've sort of focused mainly on captive insurance companies and particularly US owners of those captive insurance companies, offshore locations, sort of Guernsey, Bermuda, and the likes. Those that haven't made an election with the US 953D for the US tax status and not authorized by a state will actually have to assess their FATCA status. If they're authorized by a state, there's a determination that they may be a US person and potentially likely to be a US withholding agent. So that would be quite important if you had an onshore US vehicle within Vermont or one of the new up-and-coming domiciles, Texas, I guess, one of those, and transferring that risk to another entity offshore in Bermuda. You may actually become the withholding agent. And there's a lot of obligations on that individual who puts their name forward to that, which I'll explain. From a captive's perspective, keeping it simple, the premium goes in, that's fine, that shouldn't actually attract any sort of friction. But when that money is then placed with a bank and the interest that is given on that asset, the bank may actually require your FATCA status before giving you the interest, or maybe withhold the 30% and make the necessary disclosures to the IRS. Funds withheld is another big position in a lot of insurers' balance sheets. Again, that's an asset that may be kept with an offshore entity. From a broker's perspective, and I don't know if there's many guys from broking firms, I'd be quite interested in your most recent experience, if there is. So US source risk via an intermediary, I think that's really the sort of surplus lines market, I think could be quite challenged with that. I don't think, again, honestly myself, I paid too much attention to it. But if you take a lazy approach, you may actually find you'll be sending paperwork across that well, frankly, you can't find or you should have in place. I don't know if
you have to have new paperwork, you're going to have the W8s, you're going to have to obtain and supply to the US person withholding agent.
Yeah, and if you then move that money, that transaction on further and further and further,
exactly,
it gets very complicated. Yeah. Now, W8s should already be in place.
Not for premium.
Not for premium. Well, from I guess from my experience in the captive industry, and I had a couple of US, I'd seen two in my experience, the W8s.
You don't need it at the moment because it's under Schedule 3, but with this FATCA thing, with the added, it now becomes that you require a W8, so it's a whole new ballgame.
Wow, those tax lawyers are going to make a killing. Wow. I have to make sure I tell that to Asha. No, it's an inconvenience because you're trying to put something in place that shouldn't really apply anyway in that sense. So again, I think putting that as part of your anti-money laundering, know your clients, you have to go to your compliance department, so that's challenging in its own right, but it shouldn't incur a whole new work stream. I think that the reality of it is that the penalties and fines that may occur if you don't get it right and you pay across some funds to a client who doesn't produce their FATCA status is pretty serious. So you know, a lot of guys are really quite concerned with that. From an insurer's position, you know, classifying yourself, whether you are actually required to be a foreign financial institution or a non-financial entity, is quite difficult if you're a sort of global insurer with different lines of business. If you're niche non-life, it's okay, but if you're, you know, cross-class and a lot of those type of things, it can be a little bit more problematic to work your way through it. Again, for an insurer, it's sort of cash value products, those that primarily are in the sort of life space, which would be higher up on a radar than others. So some compliance considerations. I guess we're wrapping this up pretty soon. In the short term, I guess you need to, you know, understand whether you are a foreign financial institution or not. Again, it doesn't make sense to me to create a whole new regime internally to manage this, but bolt it onto your traditional compliance functions. Even maybe going through the process, even if you find at the end of the day you're not having to do much more, it's probably good to go through, particularly for the commercial insurers who find it difficult to keep track of the legal entities within their organisation. I know as an accountant that can be quite tricky to understand that, particularly with acquisitions and run-offs and various bits and pieces. So that could be a good piece of information that comes out of that in larger firms. The tricky piece is to understand where all the sort of business and the clients are and matching that up to work your way through the rest of the form, which is, it takes about 8 hours to do, I believe. Touching upon sort of documentary evidence, and we talked about the W series of forms. They're currently not ready. They're out for consultation, so they will be ready, I believe, on the 1st of January for completion. Other documentary evidence that clients, to evidence your FATCA status, could include documents such as tax authority confirmations, you know, regulatory licenses, and those sort of things. But I think the W series is the easy one because it's pretty clear. Others that you may come across or have heard, W9, which is an application for the identification number itself. I guess sometimes you have to be careful when you start filing forms with the IRS that you, if you should have been doing it before, that's a different discussion. I think moving on to the sort of ongoing requirements, and I think for me this, if I were a compliance officer, I'd be pretty interested in this particular section, because as a responsible officer, if I don't get it right, I've got quite a lot of serious sort of obligations. I have to put myself forward as an individual to the IRS, but not only that, after my applications, 6 months after that, the year has ended, I have to send a certification that all my internal procedures and processes in place are valid, testable, and make that assertion. And that's quite a big responsibility for a chief risk officer. And so I would imagine if you haven't already, you'll be getting some phone calls from internal audit to come and have a look at bits and pieces. But again, it's nothing that's overly technical. It's just a lot of more collection of paper, which we're trying to live in a paperless environment, can be quite tricky. So I guess I do hope this session has been informative to you. Please feel free to contact the team for more technical updates. I hope you enjoy the rest of the forum and be interested in some maybe real views on if this is an area of importance on your agenda. You've been quite vocal, so thanks a lot. Anybody else, or just an example, do we have an insurance carrier here or a captive manager?
Well, if I can say something more, you know, it will really affect, you know, or everybody involved in non-life insurance now, and there's so much still outstanding. For example, a non-financial NFE. If you've got substantial US interest, can now get a GIN, but you don't know much more.
You can't apply for it just yet until the system is live either.
Exactly.
Yeah. And that may change. You never know. Yeah.
And the other issue I'm concerned about is, in the case of non-life insurance, who is the report person? I forget what term.
The responsible officer. Yeah.
Who is is it the US broker or is it the US insurer?
I think the IRS would prefer it to be on their side, right? Yeah.
Well, the US, either the US broker or the US insurer.
Yeah.
Again, would that mean who then produces the 1042 forms?
Yeah. I, from a sort of practical perspective, I sort of haven't gone through that thought process just yet, but from a sort of captive management firm, typically the service teams would make those filings, a bit like the insurance premium tax or the tax returns. Now, I'm not sure whether you'd want to run that professional indemnity risk of signing up for FATCA, but yeah, you're right, the question is who is going to put their name down, right?